Welcome to this presentation of Aggressive Intraday Trading, Part 3. This is the Specialist Trading Weekly E-mini lesson for July 8th, 2011. This is also the third in our series of webinars where we go over this aggressive style of trading, and I'll go into detail and show you exactly two specific spots in which you can exit using this aggressive technique. But before we begin, we ask that you please take a moment to view our disclaimer. I'm going to show you performance results using this aggressive method, but remember, we can in no way guarantee that any of these results will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin our weekly e-mini lesson. All right, I want to really caution you once again, this is a strategy number one, aggressive version. This is not meant for the faint of heart. It's not meant for people who kind of want to sit back and have 1 to 3 trades a day, or want to basically, go make a sandwich or watch TV while you're trading. This is very intense. You have to really be glued in front of your monitor. And I used to trade this years before, but getting older, as I stated I think in last week's presentation, I rarely trade this anymore because it really takes a lot out of you. It can be very profitable, and it's more towards the lines of scalping, and I really try to get away from scalping in my trading of the E-mini. So remember, if you are a seasoned pro, I still ask you to take caution because this is very aggressive. And if you're a new beginner to our membership, or you're new to E-mini trading, I really strongly suggest you do not trade this and only paper trade, and learn this first, or really learn everything you need to know about E-mini trading before you start to view this, okay? Now, in the previous weeks, here's what we've actually covered looking at this aggressive version of strategy number one. Number one, we looked at small time frames, meaning that whenever you trade this, you do not want to be looking at a half-hour chart or an hourly chart. You want to be looking at small time frames from anywhere from 5 minutes or less. Even we would suggest anywhere from 3 minutes or less. You'll get more signals and much more valid signals actually when you go to a lower time frame. We do not suggest looking at tick charts or range bars. It doesn't seem to work as well, so stick with minute bars. Now, the 50-period simple moving average, or the buy-sell line, the way we apply it to every other strategy at Specialist Trading, still applies. Nothing has changed here. We're not altering that. But what we are altering, in point number 3 here, are the dodging channels, where our standard baseline is a 21-period dodging setting. We're now looking only at 7-period setting and a 14-period setting. So we're trying to really tighten things up here. So we talked about this. If you're not familiar with the setting changes, look at the previous week's videos where we go into detail. But remember, we're only going to be using a 7-period dodging channel and a 14-period. It's up to you to decide which one you want to use. Now, we talked about non-confirmation entries. This goes against 75 to 80% of everything we have here at Specialist Trading, where we wait for confirmation to enter. Well, here, since it's an aggressive version, we're not waiting for any confirmation. We simply told you where you could enter. You could enter either at the mid-channel, or if we closed one tick below, or if we closed below it, you could use that to enter, and you could enter at the market if you wanted to. Just use the exact opposite for going short. We also talked about no preset stops. Coming into the trade here, we do not know where our stop's going to be. We have to wait for a pivot to form until we can actually place a stop. So we went into detail on that in the last week's video. What we're going to be covering today are the last 2 points. We're going to be talking about no preset exits. We do not really know where our exit is going to be. This is another reason why it's so aggressive. We can't really kind of formulate any risk-reward ratio because we don't know where we're getting out. We don't know where our stops are. We don't know where we're getting out. We're pretty much just flying blind here, but that's why it's so aggressive. We're going to show you 2 different techniques of how you can exit on this particular method. One is for a real quick scalp, another is for a little bit more gain and a little bit more profit. And lastly, we're going to show you a worst case scenario stop. Now, many times you'll get into a trade, it doesn't even matter if it's this aggressive version or just one of our standard strategies, and the minute you get in, it's wrong. It goes against you. It goes the entirely wrong direction. So you have to have some type of stop in place. We can't just sit back and wait, because we could lose anywhere from 5 to 10 points very quickly, especially if some news comes out or some type of event happens in the world. So we have to have a worst case scenario stop, and we'll show you what we feel that best placed is. All right, so let's look now at a chart just for looking. This is something we looked at actually last week, and let's review, but let's show you where you could actually enter into this trade, and then where you would place your stop, and then where you would exit. Now, This is, I believe, a 7-period Donchian channel setup. We have, in the beginning, we have all three headed upwards, even though you can't see this one. They're all coming from an upward position. So once price touches the midline, here we have the green arrow, this is where you would enter. Or if you wanted to enter a little more conservatively in this aggressive mode, you would enter once we closed below and you would buy at the market. And then once you're in, you don't know where you're going to place your stop. You have to wait for the first pivot to be formed. And once it's formed, that is where you would place your stop. Okay? And so on and so on. We see different places here where you would enter at the midpoint. Once we turned up, place your stop, enter at the midpoint, or you would enter once we closed below, once we headed upwards, and you place in your stop, and so forth. So this is the same technique once all three Donchian channels are headed in some direction. But where would we exit? Well, here's our first exit at point A, and it's a quick scalp. This is something that you're going to be in maybe for 3 to 5 minutes, sometimes only one bar. And what we're doing is we're exiting on the first close above the midline. All right, so let's look at this first example back here. If we entered at the midline and we placed a limit order right here, the first close above is where we exit. We would simply either most likely sell at the market. So on this type of exit, you're not going for a large gain at all. You're going from anywhere from 1 to 2 ticks, anywhere from 25 to 50 cents. But you're going to get a lot of them. If you go down to a 1-minute chart, you'll see a number of these. But let's take the second example we have here. You would have entered right here. Once you closed up here, you would have sold, probably would have broken even, but had you purchased on the close below, you would have probably made a tick. Now right here, had you purchased at these levels right here at the midline, you would have waited for the first close and sold at the market, you would have probably made 25 cents. All right. Had you purchased right here at this midline, okay, the first close, you would have possibly broken even, or if you waited for it to come up here, this is where you would have made a little bit more. Here's another entry right here. We could have either entered right at the midline, or we could have waited for the first close below. Once we're in, we wait for the first close above, which was right here. You would have made, once again, a tick or so. Had we used this technique right here, we would have entered at this point, and here's our first close above, roughly. Now, as you can see, many times you'll close just a little on the same bar. You have the option of waiting one more bar, because many times you'll enter and the close will be on the same bar. A lot of times it's best to wait for a little bit more, another close rather than that, as we saw in this case right here. You would have entered right here and then we closed above. But what you want to do many times is just simply wait for the next bar to have another close. So oftentimes, even though this is not a rule, a suggestion is if you enter and the close is above the midline on the very same bar, I would wait another bar to see if there's any more follow through, such as we had right here. Okay? So this is a very quick scalp. You're really going to, on average, just make 1 to 2 ticks. Now, the only reason you're doing this is because it's so quick, and also because you're looking for volume. If you're trading 10 times a day, making $12.50, it can add up depending on how many contracts you have. A lot of people like to trade this way. As I said, I used to trade this way. Just really don't relate to it much anymore as I get on in my trading years. All right, so now let's look at another technique. We're going to continue to look at this same chart where you would have entered. The two options of either entering at the midline or if we closed below. But now we're going to look at something that has a little bit more potential for more gains, and this is the point B here of exiting. And it's similar to our standard strategy number 1, exit. But what we're doing now is once we're in the trade and once we have our pivot formed, we have our stop place, we're waiting to see not where if we touch the top Donchian channel, but once we go through it, once we make the top Donchian channel head upwards again, on that first time it makes it go up again, we simply sell at the market. All right? So as you see here, you would have had a nice gain of 1 to 2 points. We would have entered roughly at these levels, and once we got up to the top Donchian channel, we go through it, price goes above that, and that's your signal to exit. But we're not going to simply wait for it to touch the way we do many other times with strategy number 1. We're waiting for it to go through. Now here's an entry, once again. Now had you used exit point number A, you would have exited for roughly a tick or so. But had we not, and waited for exit point B, we would have been stopped out because we never went up there. And we would have entered again, once again, and this time we would have made everything back because once we went through the top Donchian channel, we raised the Donchian channel upwards, that's where we exit. We have another entry either here or down here. We wait for price to rally. We don't wait for it to touch, it has to go through on this tick, and that's where we sell the market. Okay? And it's simply right here, we haven't had enough time to see if we exited the trade yet using this secondary version here. All right, let's look at a 1 minute chart using those two techniques. All right, we're headed lower. I believe this is a 7-period setting on the Donchian channel. Now we could either enter at these different points, either touching the midline or once we closed above the midline. We have all these different areas to go short. Where would we exit? Well, here's point A. Once again, we entered short here. Here's where we close below. It's the same bar. Remember we had stated this before. We wouldn't use the close of that same bar. We want to wait for another bar to close below, and that's this bar right here. So we would probably be making roughly about a point on this particular 1 minute trade, even using this more of a scalping technique. We would have gotten short once again here. We would have not have used this exit level using this 1 bar, so we're still in the trade. We wait for a pivot to be formed before we place a stop, and here's our first close below. So we probably would have made roughly about 1 to 2 ticks on this trade. We enter here short once we touch the midline, or we close above. We wait for our pivot to be formed, and that's our signal to place a stop. Once we sell off, here's our first close below, so we would have covered at the market. Here we would have made close to a half a point or 3/4 of a point. We could have gotten short up here once again if we closed above using that technique to go short. And here's our first close below. This was more of a point. So you see, this was a more volatile market, but it gave us a lot more opportunity to make some gains here on this quick scalping trade. We had another instance to go short here. We entered short. We would not have taken this signal, but here's the next bar where we closed below, so we probably would have made a tick or so here. Had we shorted here, we would have covered once again down here. But here's where we would have had another chance to go short. This is where this technique, many times you go to the well once too often, you go short, and look what happens. It never goes your way, and you get stopped out on the first pivot bar there. So this is using technique number a quick pivot, and what we're basically doing is waiting for price now to close, the first close below the midline. If we want to go for some larger gains, let's go to point number B here. This is our secondary type of exit level, but remember we're waiting now for price to go below the lowest Donchian channel, and that's our signal to cover. So once we make the Donchian channels head lower, we simply buy at the market. Here's where we entered once again. Now we're not simply covering at the first close below, we're waiting for a little larger gain. Once we touch it, this is not our signal to cover. We have to go below it, and then we cover at the market. Same thing here. We had a number of multiple entries we could have taken. We touched the Donchian channel, then kind of bounced, but then went below it. That was our signal to cover. Went short here, these levels. Went below the Donchian channel and covered. Okay? You see how that works. All right, so let's look and see what happened today now. This is, it's not enough just to look back in hindsight. I want to see if this really works in real time. Once again, this is very aggressive. Sometimes you'll get tons of trades. Other times you won't get a lot, but it's still very intense trying to monitor them. This was coming into this morning using a 7-period Donchian. All right, now we had a rather large sell-off on the morning coming out of some news, but we really don't care about that. We're just simply watching the market, letting the market tell us what to do. We're obviously below the buy-sell line. We have the 7-period Donchian channels headed lower. So we're waiting for price to touch the midline. That's our signal to enter using this quick technique. Once we entered, here's our very first close. But remember, we don't want to take that. What we're really taking is this close right here because we don't want to really use the same bar. So we have both A and B on this bar right here. Here was our first bar that we caused the bottom Donchian channel to go lower, so you would have covered at the market, or here was our first close using exit technique number A. Here's where we entered short again. On the first bar we closed below, so we don't want to really take that bar. Here's the next bar where we closed below. This is where we cover the trade, and we made roughly about a point on that. Now we could have shorted once again on this 2-minute bar at the midline or on the first close above. Say we closed on the first close above, we would have had a choice here to actually simply exit once we went below the Donchian channel low. Okay, the low Donchian channel headed lower again, and that was our signal to cover. But if we waited for exit point A, there was actually no close below the midline. So we ultimately would have been stopped out. So this is where you have to know both exit points. Sometimes while you're waiting for one, another one may occur, and I would suggest taking whichever happens first. All right, here's another point of entry right here. Even though we started to head upwards in the Donchian channels, at this point, all three headed lower. So this is an exit point right here, either at the midline or the first close above. Once we headed higher, but then headed lower, we place our stop. Now we could have taken point A to exit on the first close below, or point B once we went through the lower Donchian channel. And then finally, this one got a little tough here towards the end, meaning that the trend was probably going to change. You could have shorted right here, roughly around 331, or if you wanted to be more conservative, short on the first close above, about this was at 330.5, this was at 331. And things didn't go your way. In fact, the trend continued to go higher and higher. It wasn't until we got to this point that we had a pivot form, so we would have placed our stop up here. Now, if you're exiting on the first close below, you would have covered your short right here using exit level A, and you probably would have lost 1 or 2 ticks. But had you waited for exit level B, you would have covered down here and made a nice point or two on that particular trade. So sometimes you have to wait a little bit longer. Now, this was roughly a long trade for a 2-minute trade. You would have been in this trade for about 10-15 minutes. That's more time than we usually allot. Usually you're only in the trade for about 4 to 5 minutes. So as you see here, we had roughly about 3 or 4 trades in the morning, in the first hours of the morning, and they were all profitable. Checking out now towards the end of the day, we're looking at a 3-minute bar on a 14-period Donchian channel. And there weren't a lot of signals here. We had this rally at the end of the day, but you still could have taken advantage of it. At this point, all 3 Donchian channels are headed higher. We are above the buy-sell line. Now we would have come down and touched. Had you entered right here on this first one, you would have taken a quick scalp and exited at point A once we closed above. Had you wanted to use the more conservative version, you could have entered once again on the first close below the midline. All right. We headed lower, but then we stopped and formed a pivot, so here's where your stop would be. And then ultimately, you could have exited on this close here, the first close above, or I would suggest once you traded and made the Donchian channels head upward again, so you see how we touched this top and then went above it, went through it, that was your signal to exit at the market. So there, you would have had a couple of point gain there in the last 10 minutes and taken advantage of that rally that happened at the end of the day. So we also need to know a worst case scenario stop, and this is basically where things automatically go against you the minute you enter a trade. Many times you'll buy, and the minute you buy, it goes straight down. There are no pivots made. There's no place to place a stop. Or many times you'll sell, and the minute you sell short, it goes straight up. A pivot isn't formed, and it just continues to go higher and higher and higher. So you have to have a worst case scenario stop. Now, on average, you're going to be making roughly about a point on these trades when you have a really nice, volatile market. So, and that's when the worst case scenario usually happens, when it's a volatile market, when things are really moving quickly and fastly. That's when you get to seem to be caught up in these really bad situations. But you'll be averaging basically about a point or so. So what we want to do is make our worst case scenario stop 3 points in the opposite direction. This will mean that it'll take you about 3 trades to make back what you lost. I know this isn't a good risk reward ratio. A lot of people will be saying, well, boy, I'm risking 3 points to make 1 point. But remember, this strategy, this aggressive version, does not follow those rules. This is a aggressive day trading strategy. We're not looking here to follow any type of risk reward type of consistency. We're looking to make some quick trades, and we're just jumping in and scalping very quickly. So if we have a lot of volume and we most of our trades here do fairly well. If they make on the average about a point, well, it'll just take us about 3 more trades to make back what we lost on this one worst case scenario. So we would suggest right off the bat, once you enter into a trade, quickly place your stop 3 points above if you're short or 3 points below if you're long. That way, if things just turn immediately against you, if some news comes out or some worldly event happens, at least that's the worst you're losing, 3 points. Okay? That's our guideline. All right, let's review. Once again, we talked about all the topics here in the last 3 videos, using small time frames, still applying the buy-sell line, only using 7 and 14 period Dodging channels. There are no confirmation entries. You're either going to be entering once you touch the midline or once you close below the midline to go long, and vice versa to go short. There are no set stops. We are simply waiting. Once we've entered, we're waiting for the first pivot to be formed, and that's where we're going to place our stop, just below that 1 tick below. There are no set exits. We have 2 exit plans that we shared with you today. The first one is, if you're long, it's the first close above the midline. That's where you simply exit at the market. Or you can take a little bit more of a approach where you want to get some more profits out of the trade. You wait for price to alter the top or bottom Dodging channel. If we're long, we want to go 1 tick above the high Dodging channel. That's our signal to exit at the market. If we're short, we want to see price dip 1 tick below the lowest Dodging channel line. That's our signal to cover at the market. And lastly, our worst case scenario stop is 3 points. Okay, on average, you're going to be making about a point on these trades, especially when there's a fast market. So it'll take you about 3 or so trades to make it back. And the worst case scenario happens maybe once every 1 or 2 months. So don't worry, this is not going to be something you're going to be seeing on a daily basis. All right, points to remember. Once again, if you are a beginning trader, please do not trade this. If you're new to trading, your eyes may light up and say, wow, this is so easy. I can be making 3 to 5 points a day using this technique. Sure, but you could also, if you don't understand it or aren't quick enough to trade this, you're not intense enough to trade this style, you'll also lose that much. So this is for advanced traders. Even for some advanced traders, I wouldn't recommend this. You have to really be glued to your monitor and following every tick. Remember, use small time frames. 5 minutes or less, probably 3 minutes or less for some more advanced traders. Our buy-sell line still applies, and we only use the 7 and 14 period Dodging settings. This is extremely aggressive, so we always recommend you to paper trade. Learn this strategy, but paper trade, even if it's for a couple of weeks or even a month. Paper trade it because you're really going to see how it unfolds in real time. You may paper trade this for a couple of weeks and say, boy, I'm so glad I did because I really can't follow this. This is too aggressive for me. It's too intense. I'm glad I didn't jump in or I would have lost a good chunk of money. So paper trade. You also may paper trade and say, boy, this isn't as bad as I thought. This is more my style. I'm going to trade this rather than trade the standard day trading version of strategy number 1. I'd rather trade this more aggressive version. So learn this strategy, but paper trade. Our edge here is consistency, even though there isn't a lot of formula to this where we're sticking to our basic formulas of our strategies. We're basically scalping here, which goes against most of what we do. It's okay. There will still be this level of consistency if you learn how to monitor this strategy and paper trade for us. So you'll see there is a level of consistency here, but you must learn it. You must paper trade. If you have any questions concerning this or anything else on our website, please do not hesitate to email me at stevenprimo@specialisttrading.com. In closing, I asked you to take one last look at our disclaimer. I showed you a lot of performance results and I showed you a lot of different ways to trade this aggressive version. But remember, we can in no way guarantee that any of these results will be repeated in the future. Remember, once again, this is extremely aggressive, not for everyone, so please, please, please paper trade it in the beginning in order to make your decision as to whether you want to trade this or not. If you have any questions, email me. If not, have a great weekend, and we shall see you here next week. Bye-bye.